everybody? This is Chase with ChaseNCredit, like saying that, ChaseNCredit. Back for a little bit more information about business credit. In another video, we talked about, will too many credit cards affect your credit score? And hopefully we answered some good questions in that video. If not, leave some comments below and we will be checking them and be sure to answer those probably in another video. So today we're going to be talking about the 5 credit scoring factors that make up your credit score. So I think that will be very important to pay attention to because they're going to break down that pie, right? That 100% pie that will make a difference, and what you need to pay attention as you're doing things with your credit, whether it be with credit cards, lines of credit, mortgage, car payment, that could easily affect your credit. So hopefully you get something out of this. I look forward to talking about it because it's so easy to, even for me, to think about what I'm doing as I'm doing it, and every move that I make that could affect what I'm actually doing. So number one of the credit calculation that makes up 35% of your score is payment history. So when you want to think about that, you want to think, have you missed any payments that went over 30 days, right? Which will show up in your credit profile, especially if you're using credit check total. As soon as you log in and it gives you on your platform, it'll show you if you have any 30-day lates. And if you break it down a little bit more, it'll show you if you got any 60-day lates, any 90-day lates, any 120-day lates. I mean, it'll break it all down. But when you think about payment history, so have you been late? How often have you been late? And it'll go all the way back of, how many months out have you been late? And it can go back 5 years, right? So you really want to pay attention to that, because all that plays a factor in your credibility. So payment history plays a big part in your score. So 35%. So think about it. 35% of that 100% pie. So basically a whole pie, and you cut a slice, that a 35% slice out of that pie. That's a pretty big slice of that pie, which accounts 35% of your score, which could affect a big part of your score, bringing it down. Or if you got a really good payment history, could really increase your score a great deal. So we really want to pay attention to that and not ignore that, like many of us in the past, or should I say, let me talk about me, like I have in the past, and by accident or on purpose didn't pay attention to that and affect my score. I mean, I literally watched my score drop by not staying on top of my payments. And that one day when it goes from 29, 30, 31 days, so I'm over 30 days late. So I can't speak on that enough. You do not want to be over 30 days late, because it's hard to get that off. It's hard to outlive that. So number 2 is credit utilization. So debt to credit. So again, and that's 30% of your score. So we're already at 65%. So if you think about, again, give you an example, if you got 5 credit cards, each credit card has a limit of $10,000. So that's $50,000 available to you, right? But in the last so many months or whatever, you've used all $50,000 of those credit cards, you maxed them all out, then that means you're at 100% utilization. Cut and dry. Simple math. So that means when you go into Credit Check Total or some of those other credit monitoring sites, they're going to show that you are at 100% utilization. Guaranteed, your score is going to drop, maybe even bottom out. I don't know the mathematics they use on that, but that's a no good. Now let's flip it around. If you got $50,000 worth of credit available so 10,000 each on 5 credit cards. So we're talking about revolving credit. We're not talking about loans, car loans, student loans. We're not talking about that. We're talking about revolving credit, which is credit cards. So if you have 5 credit cards, $10,000 each, and you pay them off, you don't hold any debt on them. So they're going to have you at 0% utilization, or maybe 2% or 6%. The rule of thumb is under 30 or under 20 or under 6. But if you are down to 0 and 0% utilization, that could like skyrocket your score. I mean, it could probably add 100 some points on your credit score. So you might be in the 7s, you might be in the 8s. I mean, that's huge. So rule of thumb, you want to keep that utilization as low as possible. You do not want to max your credit cards out because that's an easy, you're going to get an F for the day. That's an easy F minus by maxing out your credit cards and lowering your utilization down. So utilization up, and you're sure to be a winner. So number 3 is length of credit. That stands for 15% of your score. So again, we're eating away at that pie, right? We got pie all over our face, all around our lips. 15% of your score. So what they're saying is, if you got some of those 5 credit cards, same 5 credit cards, if you've had those credit cards for a very short period of time, like you just applied for them, they each, Citi, Bank of America, Discover, if they just gave you those credit cards in like the last 6 months, usually they're not going to give you a lot of credibility for that, right? It's going to show up on your credit report as new credit, right? So it's not really going to help you. They're going to ping you a little bit. But what will help you is if you've had those same credit cards, again, Bank of America, Citi, Discover, if you've had those same credit cards for say 5 years or 10 years, the longer the better, right? Rule of thumb, the longer the better. That's why we did another video on do not close credit cards, right? Let them sit there. Let them sit there and don't do anything. Let them sit there and chill with a kickstand on. The longer you've had those credit cards, the better it's going to help you. So length of credit is 15% of your score. So now you see why that's important. Just keep them. Let them sit there. So the longer the length, the better it is. The shorter the length, they don't necessarily help you, because what it does is it makes it seem like you're going out and applying for a bunch of credit. At least that's the way they see it. So once you apply for some credit cards, let them sit. Do not go out on a credit card spree and applying for a bunch of credit at one time, because it makes you look bad. And then at some point, after a few credit cards, they're going to start denying you because it looks like you're going around and racking up a bunch of debt. So rule of thumb, get the credit cards, keep them for a long period of time, right? 15% of your score. So same thing, adding a new account, right? Just like I was just saying, going around and adding a new account. So usually that could be even applying for a new car, right? So that's a new account. New credit card, that's a new account. Getting a new house, that's a new account. So usually a new account is like 10%, right? It's a little bit smaller, but 10% of the pie. Again, right? The pie is almost gone. Just in case you want to offer somebody else some, you don't have that much left. 10%. So that's a new account. So, but just keep that in mind. So you are going to want to apply for things. You are going to want to get a car. You are going to want to get a new house. People say the rule of thumb, people kind of move every 5 or 7 years. So that's okay, right? But just watch it when it comes to the credit cards. It's totally different from business credit, but again, 10% when you apply for a new account. And when you get that new account, it's usually going to drop your score down a little bit at the beginning, and then after that, it's going to work its way back up. Right? It's not going to ping you as hard at the beginning. Long term is just because you applied and you got a new account, because now it's more debt, and then it's going to recalibrate at some point and work its way back up. So it's not long term, but it will get you. Now, number 5, the 5th factor, last but not least, right? Number 5, inquiries. So you're going to get an inquiry. So that's whether you're going to apply for a mortgage, whether you're going to apply for a new car, whether you're going to apply for a new refrigerator, whether you're going to apply for credit cards. If someone's checking your credit, right, student loan, it don't matter. When they're applying for when they're checking your credit, you're going to get an inquiry. It really don't matter what kind of credit you're applying for. It's an inquiry. Somebody could say, hey, we're just going to do a soft pull, or we're going to do, or this is definitely a hard pull. I don't understand the difference, because it still shows somebody pulls your credit. But that's an inquiry. That usually counts for 10%. So that's your 100% right there, total pie. Right now, you got is an empty pan with the pie sauce on it. But so you got to watch those inquiries. Inquiries, they from what I've seen, rule of thumb, usually it's like 2 points per inquiry or 3 points per inquiry, or sometimes it's none. But sometimes you can see if you got the credit monitoring systems, you can see your points go down a couple per inquiry, right? So it varies. Sometimes if you're going around and you're shopping for a car, but you're doing it all on the same day, or you're applying for a credit card, say American Express, and you're applying for a couple of credit cards with American Express, all at the same time, it might only be a couple of inquiries all for the same bank. There's a couple of tricks on that, but but there will be some inquiries every time somebody's checking your credit, and there will be points taken off every time someone's checking your credit. So it's a rule of thumb. There's no way around it. It's just how they set up. So don't be afraid of inquiries, and don't be afraid of someone's checking your credit. That's just how it's set up. So those are the 5 factors that goes along with the credit calculation that goes with someone checking your credit. So it's how it is. So when someone says, okay, we're going to check your credit, hey, that's why you got credit, right? That's why you got a Social Security number when you came out and the doctor smacked you on your bottom and you was given a Social Security number. At some point, you was going to have a credit file without you doing anything, right? So hopefully you got something out of that. Hopefully it worked for you. Hopefully you learn to build on that, right? It's not a living, breathing organism, but it can help you live a whole lot better, right? With that, so when opportunities come, be ready for them, get in front of them. As Will Smith say, if you're ready, you don't have to get ready. So again, if you got any questions, leave them below. If you're not subscribed, subscribe below. Make sure you're out there chasing credit, because you're going to need it. If not today, probably tomorrow. And again, hey, this was Chase with ChaseNCredit, and we'll be talking to you soon.